Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Now, if you've ever applied for business funding and felt like the bank already made up its mind before you even walk in the door, then this video is for you. And if you've ever been told no because your credit score wasn't perfect, or your business was too new, or you didn't have years of tax returns ready in hand, then this video is absolutely for you. This will be part 2 of a different video that I did about lines of credit. In part 1, we broke down traditional banks and how they underwrite lines of credit, as well as the best way that you can use this product. Now, if you haven't watched part 1 yet, I strongly recommend that you watch that video after this one. I'll put a link in the description. With that said, today we're going to shift gears and we're not going to be talking about traditional banks, but instead we're going to be talking about lenders and funding sources that approve far more people than banks ever will. Today we're talking about fintech lenders. These are the same tools that thousands of business owners use every single day to fund operations, to cover expenses, to scale faster, and survive when banks say no. And yes, bad credit is allowed in many of these cases. So without further ado, let's get right into the video. We've discussed fintech companies before, but let's briefly review this topic one more time. Fintech is short for financial technology company. Now, these organizations use technology to provide innovative financial services, making them efficient, accessible, and far easier to get approved for than traditional banks. Now, for clarification, these are not banks themselves in the traditional sense. These are tech companies that partner with banks, or they partner with some investors to provide financial products using software, automation, and data instead of human-driven underwriting. Traditional banks rely on rigid underwriting guidelines, manual reviews, and conservative risk models. Fintech lenders rely on data, algorithms, and speed, and that difference alone is why fintech lenders approve more borrowers than banks ever will. Now, that speed is not just convenient, it's also strategic. It allows business owners to access capital when they actually need it, not months later when the opportunity is gone, but there's always a trade-off. While fintech lenders are easier to qualify for, the capital can be more expensive, and that's just the reality. Anyone who tells you otherwise is just not being honest with you. Traditional banks lend money that mostly comes from deposits, and that means they can afford to charge lower interest rates because their cost of capital is lower. Fintech lenders are lending investor money, and investors expect returns. So those returns come with far more higher interest rates and a shorter repayment term. With a traditional bank, you might see interest rates tied closely to the prime rate, often in the range of the prime rate plus maybe 1 to 6%, depending on whether that's a line of credit and if it's secured or unsecured. With fintech lenders, interest rates commonly range from 10% on the low end to well over 20% on the higher end. And that sounds scary if you don't understand how to use these products correctly. But for many businesses, access matters more than the cost in the short term. The key is understanding when fintech funding makes sense and how to use it strategically. Most businesses don't choose fintech lenders because they want to pay higher interest. They choose fintech lenders because they have no other choice, or because speed matters more than cost. Many business owners get denied by banks due to a lack of profitability on paper, insufficient time in business, missing documentations, or personal credit issues. Others simply cannot wait for an approval. Fintech lenders fill that gap. They care far less about your story and far more about your revenue. So if your business is generating consistent income, fintech lenders are willing to take a risk even if your credit profile isn't perfect. And that alone opens the door for thousands of business owners who would otherwise be locked out of funding. One of the biggest advantages of fintech lenders is how little in time in business they require. While banks typically want to see 2 years or more of operating history, most fintech lenders are comfortable approving businesses with as little as 6 to 12 months of history. Like I said before, revenue matters more than age. Most fintech lenders want to see a minimum of $10,000 per month in gross revenue, and that revenue needs to be consistent, not a one-time spike. If your business is producing revenue and depositing into a business bank account regularly, then you're already meeting the most important requirement. This is why fintech funding is not ideal for pre-revenue startups. If you're not making money yet, this is not the lane you want to be in. But if you're already generating income and you just need capital to grow, fintech lenders can be extremely powerful. There are ways to create cash flow on paper. I've talked about this in many videos. However, I want to give a disclaimer with this. I don't recommend that you try to borrow money if you don't have the cash flow to pay it back. I would say 9 times out of 10, you will end up failing, and then it will just put you in debt, and that could set you back for several years when you have to try and clean that up. Now, with that said, the next section is where fintech lenders really separate themselves from banks. Traditional banks want strong personal credit, often 700 or higher. Fintech lenders are far more flexible. Many fintech lenders will approve borrowers with credit scores in the 500 to 600 range. Some are even more flexible depending on revenue strength. That doesn't mean credit does not matter at all. It just means that it matters far less than revenue. If your business is bringing in money consistently, then fintech lenders are willing to overlook past mistakes. That's why this video exists. This is where bad credit stops being a deal breaker. Instead of asking for tax returns, profit and loss statements, and financial projections, fintech lenders typically ask for bank access. Most of them require secure read-only connections to your business bank account, and that allows them to see your deposits, your cash flow patterns, and revenue consistency instantly. This is how they can make decisions so quickly. Some fintech lenders allow you to upload bank statements manually if you don't want to connect your account. However, the majority prefer direct access because it speeds up this process. The first fintech business line of credit that I want to start with is Fundbox. Now, this is often the entry point for business owners who cannot qualify with a traditional bank. Fundbox was built to solve that problem. It's a financial technology company that focuses on giving small business owners faster, more flexible access to working capital. Since 2013, Fundbox has connected to hundreds of thousands of small businesses, and they've helped owners access funding when banks said no. Now, the application process is entirely online. It requires no traditional paperwork, and decisions can be made in minutes instead of weeks. Applying does not impact your credit score, and if approved, funds can arrive as soon as the next business day. Now, to qualify, your business must be based in the US, you must have a business checking account, and you must be operating for at least 6 months, and you have to generate at least $30,000 in annual revenue, which roughly breaks down to around $2,500 per month. But again, I recommend having at least $10,000 to $20,000 in your business bank account with continuous revenue going into that account for at least 90 days. On the credit side, Fundbox typically looks for a personal FICO score of around 600 or higher, which makes this very accessible to business owners with fair or less than perfect credit. This is exactly why Fundbox earns the first spot on this list. It's designed for real businesses with real revenue, not just perfect credit profiles, and it serves as a strong starting point for fintech funding. The second fintech business line of credit on our list is Bluevine, and this is where many business owners step it up when they need larger credit limits and more flexibility than just an entry-level fintech option. Bluevine is a well-known financial technology company that specializes in revolving business lines of credit. The application process is fully online. It takes just a few minutes to complete, and Bluevine will use automated underwriting, which allows many applicants to receive a decision in as little as 5 minutes. Applying doesn't impact your credit score in the initial stage, and if approved, your funds can be accessed quickly, sometimes as soon as the next business day, especially if you use a Bluevine business checking account. To qualify for a Bluevine line of credit, your business generally needs to be operating for at least 12 months and generate at least $10,000 in monthly revenue. Bluevine typically looks for personal FICO credit scores of around 625 or higher, which is still more flexible than most traditional banks. Now, your business must be properly registered in the US, it must be in good standing, and you need to have an active business checking account that Bluevine can review for cash flow activity. There are some states where this product is not available, so if you want to see a full review, check out my video that I did on Bluevine. You'll find all the details there. Bluevine earns its spot on this list because it balances speed, flexibility, and higher funding potential. So if you're a business owner with steady revenue and fair credit and you want to move beyond a starter fintech lender, Bluevine is often the next logical step. The third fintech business line of credit on our list is going to be OnDeck. And this is one of the most established names in the online business lending space. OnDeck has been around for years, and it's known for offering fast access to working capital for businesses that may not qualify with traditional banks. The application process is handled almost entirely online, and many business owners receive a decision within minutes. OnDeck is a good fit for businesses that are a little more established and looking for higher funding potential compared to entry-level fintech lenders. While approval is still much easier than traditional banks, OnDeck does expect to see a track record. To qualify for an OnDeck line of credit, your business generally needs to have been operating for at least 1 year and generate around $100,000 or more in annual revenue. OnDeck will typically look for personal FICO scores in the low to mid 600s, which keeps it accessible for business owners with fair credit. You'll also need an active business checking account so OnDeck can review your cash flow and manage repayments. OnDeck earns its spot on this list because it bridges the gap between fast fintech funding and more bank-like credit limits. For business owners with steady revenue and average credit who need flexible access to working capital, OnDeck is often a strong third step in the fintech funding space. The fourth fintech business line of credit on our list will be Fora Financial. Fora Financial has been funding small businesses for years, and they focus on revenue-based approvals rather than you having a perfect credit profile. The application process is fully online, and it's designed to move quickly. You will receive a decision within hours and funding shortly after approval. Now, this makes Fora Financial a strong option for owners who need capital to cover payroll, inventory, marketing, short-term cash flow gaps without waiting weeks for a bank response. To qualify, your business generally needs to have been operating for at least 6 months and show consistent revenue. Fora Financial typically looks for a business generating solid monthly sales of around $20,000 per month and is known for being more flexible with credit, often approving owners with personal credit scores in the 500s or higher. An active business checking account and recent bank statements are required so the lender can review your cash flow. Fora Financial earns its place on this list because it prioritizes speed, accessibility, and for business owners who have steady revenue with less than perfect credit who need funding quickly, this can be a practical fourth option in a fintech funding strategy, so I highly recommend that you check this one out. The fifth fintech business line of credit on our list is going to be Biz Credit. Now, this option is geared toward business owners who have steady revenue and are ready for a larger credit limit, more than just an entry-level fintech lender will typically offer. Now, Biz Credit operates an online lending platform that will connect a business to revolving lines of credit that are designed for cash flow management, inventory purchases, payroll, and growth expenses. Now, to qualify for a Biz line of credit, your business generally has to be operating for at least 12 months and show consistent revenue of around $20,000 per month. Biz Credit will typically look for personal credit scores in the mid 600s or higher, and they require recent bank statements so it can evaluate your cash flow and your overall financial health. I have an entire video on Biz Credit showing you my experience when I qualified for one of their loans, the cost of borrowing, and everything in between, so I highly recommend that you watch that video. Biz Credit earns its place on this list because it sits at the higher end of the fintech spectrum. And for business owners with solid revenue, fair to good credit, who want access to larger revolving lines of credit without going through a traditional bank process, then Biz Credit can be a strong fifth option. The sixth and final fintech business line of credit on our list will be OneWest, which is a digital small business financial marketplace that connects owners to flexible funding options through its automated lending engine. Now, this one is a little bit different. It doesn't function as a single lender. You can get matched with multiple loan partners in a network, giving you choices to helping you find financing that fits your cash flow needs. Now, the application process is online, it's fast, and it's designed to save you time compared to a traditional bank. Most businesses can receive approval decisions quickly, and once you're approved, the funds arrive in as little as 48 hours, depending on the lender that you are paired with. To qualify for a line of credit through OneWest, your business generally needs to have been operating for at least 3 months and show consistent cash flow with at least $10,000 in gross monthly sales. OneWest can work with business owners who have lower personal credit scores, sometimes starting around a 500 FICO score, depending on which lender in the network you are matched with. To qualify, you need to have an active business bank account and recent bank statements, and that is required for underwriting so they can assess your revenue patterns. Once you submit your application, OneWest system will match you with multiple lender options, and you can choose the one that best fits you. OneWest earns its place on this list because it's a combination of speed with the ability to connect a business owner with multiple credit options all at one time. For business owners with fair to bad credit who want multiple options, then I highly recommend that you check out OneWest. This is a very good way to close out this list. I want to thank you guys so much for watching this video. If your credit is not where it needs to be yet, that doesn't mean you stop moving forward. Fintech funding can bridge that gap while you repair your credit. And this is how real business owners grow. They don't wait for perfection, they improve while moving forward. The key is knowing which tools to use and when. Now, if you found value in this video, please make sure to like and subscribe to the channel. This channel exists to show you how to access funding, how to understand credit, and build real financial leverage. Once again, thank you so much for watching this video, and you guys have a wonderful day.